exam question 3. So it says that 007 Traders is a registered VAT vendor that buys and sells hardware products and uses the perpetual inventory system. Okay, a theory might come there. What is the perpetual inventory system? So a perpetual inventory system is a method in accounting for calculating inventory immediately after the sale or purchase. So basically with perpetual, if we made a sale on the first, right, on that first, we have to record the sale that we made. So that's perpetual. So perpetual is a method in accounting for calculating inventory immediately after the sale and purchase. Yeah? And then what is the opposite of perpetual? Perpetual, the opposite of that is periodic inventory system. So periodic inventory system, now we record inventory after a physical stock count has been done or made. Are we fine so far? So this question, it might pop up on your theory. What is perpetual inventory system? So know that with perpetual inventory system is a method in accounting for calculating inventory after the sale or purchase it was made. So if we made the sale on the first, we're going to record it on the first. Immediately when we made the sale, we record it same time. Are we fine? And then with periodic inventory system, we only record inventory after we made the physical stock count. Right? Okay. And then it says the information. Below you will find transactions that occurred during the month of February 2019 that have not yet been recorded in the books of 007 Traders. And then VAT is levied at 15%. Right? So, okay. 3.1, our requirements. So it says prepare the general journal for all the transactions for February 2019. It says show all your calculations. Journal narrations are required. Classifications for each account are required. SFP and SPL. Run off your answers to the nearest 2 decimal cents. Right? Please, tomorrow before you start your test, read the instruction carefully. Are we running off to the nearest whole or to the nearest 2 decimal places? Right? So, okay, let me start with, because I saw most of you, you are struggling with this SFP and SF what, right? So, SFP. So this one is a statement of financial position, right? So here we're recording our assets, we're recording our equity, we're recording liabilities, right? And then you have what we call a statement of profit or loss. So this one, okay, so it's a statement of profit or loss, known as income statement, right? So here we are recording income and expenses. Are we fine? So income and expenses are recorded on the statement of profit or loss, right? And then statement of financial position, we record our assets, equity, liabilities, right? Yes, so they said we should classify our accounts, whether they go to statement of financial position or statement of profit or loss. And then we need to narrate. So in the test tomorrow, I can give you a transaction, and then we say to you, narrate this transaction. What did we do here? So I'm going to show you how to narrate. I'm going to show you how to classify these 2 accounts. I'm going to show you how do you know whether it's statement of financial position or statement of profit or loss. And then I'm going to show you which accounts are inclusive of VAT and which accounts are exclusive of VAT, right? Okay, cameraman, we appreciate you. Thank you, Prudence. Thank you. I also appreciate her. Okay, let's start. So, general journal 3.1, right? So general journal, we know that it must have debit, it must have credit, right? Okay, let me put it here because this lamp is stronger. Okay. Okay. So general journal, right? Okay. So the first transaction says 007 traders, which is us, the business. We bought 80 buckets on credit, totaling 920 inclusive of VAT from Golden Suppliers. Okay, they received a discount of 5% on this amount, right? So we made a purchase of 80 buckets at a total of 920 inclusive of VAT. And then we got what? A trade discount. So remember, first thing, I like to say, before you do any calculations, do the journal. When you buy on credit, which accounts are affected? We know that inventory is affected because we are buying stock, right? We know that when you are buying input VAT, it's affected, right? We know that when you are buying on credit, we call it a trade payable. If it was cash, it's bank, right? Okay, and then now you ask yourself, which statement does my inventory goes to? So inventory is an asset, and then your asset goes to statement of financial position, right? And then you ask yourself, input VAT, which statement? Input VAT, it's an asset. My asset goes to statement of financial position. You ask yourself, what is trade payable? Trade payable is a liability. I have a present obligation to pay back that supplier, right? So the fact that it's a liability, it goes to statement of financial position. Are we fine? So far, so good. So remember, guys, I can see your comments, né? So just let me know if you are good. Let me know if you are not good, né? Okay. And then now you ask yourself, which account here is inclusive of VAT? Okay, my trade payable is inclusive of VAT. And then you ask yourself, which account is exclusive of VAT? Inventory will be exclusive of VAT. And then this one will be the VAT amount, right? Okay, so that you might not forget that, you can write it here. So I know that my inventory, it's exclusive. What is the percentage for exclusive? 100%. And then my input VAT is the 15%, the VAT amount. And then my trade payable is the inclusive, which is 115%. So far, so good, right? Okay. And then now we are given a total of 80 buckets for 920 inclusive of VAT. And then there was a discount, a trade discount that was received at 5%, right? So we know that trade discount, we remove it on the calculation. So there's no journal or an account for a trade discount, right? So at first we start by removing the trade discount. So you take 920,000 multiplied by, so 100 minus 5%, you are left with 95%, right? And then how much do you get? Okay, let's press our calculator. So 920 multiplied by 95 times 100, you get 874. So now remember guys, remember this 920, it's inclusive of VAT. So the fact that 920 is inclusive of VAT, the answer that you're going to get, it's going to be inclusive of VAT, right? So now, which account here is inclusive of VAT? Trade payable. And then now you take the amount on which side? Trade payable is a liability. Whereas your liability increases on the credit side. So it means when I buy on credit, my liabilities are increasing, or my trade payable is increasing, right? And then now, inventory. So to get your inventory, you take the amount which is 874, multiply by what you want in terms of percentage. I want 100%, right? So multiply by 100, divide by what I have in percentage. So this amount, what is it in percentage? 115. Then I get 760. Right? Are we following? Yes, Zanele. Yes. Thank you. Thank you. Are we following? Now we need to look for input VAT. Right? So to get the input VAT, you can take the amount, multiply by what you want in terms of percentage, divide by what you have in terms of percentage. So that's 15 over 115, right? So 874 multiply by 15 divided by 115, you get 114. Are we following? So okay, the journal when we buy on credit, it won't change. So it's like that. I expect you to get this marks. 1, 2, 3, you must get it. It doesn't change. When you buy on credit, it's always like this. And then now, yeah, you'll make the plan on the calculations. But I trust you. Nah? Okay, guys, remember, if you are not following, please let me know where are you lost. Let's say you are lost on the 95%. You must tell me that, how do you get that 95% so that I can explain, right? Okay, so, okay, let me just fix my lighting. So okay, before I carry on, I am, yeah. Please let me know where are you lost, say. Let me know where you lost. 760. Okay, so the 760, I got it by, taking the 874, which is inclusive of VAT, multiply by 100%, because that's what I want in terms of percentage, divide by 115. You must get 760. Are we fine, guys? Are we fine? You see your father ESCOM. Okay, can I carry on? Ed Tando, how do we end up with 5% and why? Can you please open your question paper? The 5% it's the trade discount. The 5% is the trade discount. Okay. Thank you, Zanele. Okay. So, those who are following, can you please answer for me? I'll only come in when I see that most of you are struggling. So if it's just easy peasy, you can answer there. I'll see your comments. Can I move to number 2? Can I move to number 2, please? So number two, we returned 1 bucket of golden suppliers as it was damaged, right? So now we are the one returning 1 bucket. So remember here we bought 80 buckets. So now we are returning 1 bucket because it was damaged, right? So now with return you do the opposite of, so if it's us returning, you do the opposite of purchasing. But if it's the customer returning, you do the opposite of selling. Okay, let me repeat that. If it's us who are returning, you do the opposite of purchase. But if it's the customer returning, you do the opposite of the sales. So I believe you are following, right? So now it's us who are returning. What is the opposite of purchase? So now we're going to have what? Trade payable on the debit side. We're going to have credit inventory, and then we're gonna credit what? Input VAT, right? Okay, I'm sorry about the up and down, guys. I'm trying to make the lighting here so that you can see very well, because I'm in the dark place. Eskom happened, but I won't allow Eskom to disturb us, right? Okay, so now we are returning. So the fact that it's us returning, you make the opposite of purchasing, right? So trade payable was credited. So now trade payable will be debited. Which statement? Statement of financial position, because it's a liability, right? And then now inventory was debited. So now we're going to credit our inventory. And then we're going to credit our input VAT. Right? So, okay, you ask yourself now that I'm returning one bucket, but here I only have the total price of 80 buckets. So you ask yourself, how much will one bucket cost, right? So I have a total which is 874, right? So now this 874, it's for 80 buckets. So 874 divided by 80, you'll get a price per bucket, right? So now, what is that price per bucket? Okay, let's see. So you have 874 divided by 80, you get 10 rand 93, because they said round off to 2 decimal places, right? So 10 rand 93 cents, right? So now this 10 rand 93 cents is our price per bucket, right? Are we following? I believe so. So since we have this 10 rand 93 cent as for one bucket, okay, let me just write it here. It's for one bucket, right? Yes. So this 874, it was inclusive of VAT. And then it means now the price that you're going to get will be inclusive of VAT. Are we fine? So since the 874 is from the trade payable inclusive of VAT, it means the price will be also inclusive of VAT. So now you ask yourself here, which account is inclusive of VAT? Trade payable is inclusive of VAT, right? So it means this 10 rand will be for trade payable, right? And then now inventory. Which statement is the inventory? Statement of financial position, because it's an asset. And then input VAT, statement of financial position. Are we following? So far so good. Okay, and then remember, trade payable, it's inclusive of VAT, which is 115. And then inventory, it's exclusive of VAT, which is 100%. And then input VAT, it's the VAT amount, which is 15%. So now you want the inventory. So if you want the inventory, you're going to take the amount that you have, which is 10 rand 93 cent, multiply by what you want in terms of percentage. So I want my inventory, which is 100%, because it's exclusive of VAT, right? Multiply by 100, divide by 115. Why divide by 115? Because the 10 rand 93 cent is inclusive of VAT. So remember, amount multiplied by what you want over what you have. And then how much do you get? You get 9 rand 50 cent. So remember, our inventory is going to decrease because now we are returning the product, right? So if you are returning the product, it means now the value of your stock is going to decrease, right? So where does your inventory decrease? Inventory decrease on the credit side because it's an asset, right? 9 rand 50. And then now we need to adjust our input VAT. So from the 10 rand 93 cent multiplied by what you want, which is 15, divide by 115, you get how much? 1 rand 43 cents. Are we fine? So far so good. Thank you, Zanele. I like people who are participating. Thank you. It clearly shows that you have a calculator on your hand. Are we fine? Number one, number two. So far, so good. Okay. And then what is the narration for number one? So remember, number one, we bought inventory on credit. So basically, narration, you're telling us what's happening here. So now you have to tell the marker that here on the first transaction, we bought inventory on credit and received a 5% trade discount. Are you getting it? And then number two, what happened? We as the business, we returned the good, right? Which is one bucket. So now you tell the marker that on number two, we return damaged inventory or damaged good or damaged bucket. So basically just explaining in a short words what's happening here. Are we fine, guys? Are we fine? Can I move to number three? Can I move to number three? Can I get only 5 people to say yes? Let's move to number three. Thank you. So we are moving. Hurrying something. Let's move. Thank you, guys. Thank you. Number three. Number three. So number three, most of you are struggling with this markup and gross profit thing, right? Now, today, it will be the end of that struggle. Because whatever is taught well can be done. Today, it will be the struggle of you having a problem with gross profit or markup. Okay. So now, number three says, on the 10th, we sold 10 buckets. So we are the ones selling now. So we sold 10 buckets to a credit customer. Credit customer. Not on cash. Credit customer. Right? And then the customer is B Nkosi at a gross profit of 30% on sale. Right? Okay. So remember with Francis, before you do the calculation, write down the journal to show that you know your work. Right? So remember when you sell, it's 5-line journal. Okay? So let's start. So we're going to start with, okay, we are selling on credit. So if you are selling on credit, what's affected? Trade receivable, right? And then which statement is trade receivable? Statement of financial position, because it's an asset, right? And then now you ask yourself, when I sell, since we are selling now, so your sales will be affected. And then now your sales, it's your income. And then I told you, your income and expenses go to statement of profit or loss, right? Known as income statement, right? So your sales are your income. So now I'm going to say statement of profit or loss. So far so good, right? When you sell, right? Let me make an example with Pick n Pay. So when Pick n Pay sell goods, they charge you on 115. So that price that you are paying for your grocery, it's inclusive of VAT, right? So basically, Pick n Pay is collecting VAT on behalf of SARS, right? So now it means that 15% that Pick n Pay is collecting, it's not for them, but it's for SARS. So now, if you have a money that is not yours, but it's for someone else, so it means you have a present obligation to pay that money to SARS, right? So now that's why we're going to recognize what we call an output VAT. And then an output VAT is a liability because this money, it's not our money. We're just collecting this money on behalf of SARS. So we need to pay this money to SARS, right? So we have a present obligation to pay that money to SARS, right? So this output VAT will be a liability, and then your liability goes to statement of financial position. And then now we are not done. Remember, it's a 5-line journal. And then when you sell, what's happening? We are recognizing a cost of sales. And then the cost of sales is how much it costs you to get that product. So it's a what? It's an expense, right? And then your expenses goes to statement of profit or loss, right? Okay, and then now when you sell, what's happening to your inventory? Your inventory is decreasing, right? So it means you're gonna have inventory here. Why is it inventory and cost of sales twins or on the same journal? Because remember on your slides, we told you that inventory is recorded at cost price. So whatever the amount is here is the same as the amount of the inventory. Are you guys following? So now your inventory is your asset, né? So your asset goes to a statement of financial position. Are we fine? Yes. So now look at this, guys. Look at this. So the first three lines here, you focus on the selling price. My God. Now I'm teaching you something that your lecture didn't teach you. Whatever is taught well can be done. 1, 2, 3. Trade receivable, sales, and output VAT. You focus on the selling price. And then cost of sales and inventory, you focus on the cost price. Are you guys fine? Are you guys fine? So 1, 2, 3, you focus on the selling price. And then cost of sales and inventory, you focus on the cost price. This one is the selling price. Right? Okay, so now let's go to our information. So now this is principal mark. You're supposed to get these marks just to know that when I sell, this and this is affected before you do the calculations. So okay, it says we sold 10 buckets to a credit customer, being cost at a gross profit of 30% on sales. So okay, let's do our mini income statement. What is the income statement? Sales less cost of sales, right? Sales less cost of sales, right? You get what? A gross profit. Okay, and then you start by writing what's given. So we are given a gross profit of 30%. So it means my gross profit will be 30%, right? Now, the fact that I said less cost of sales, it means my answer here should be in bracket, right? Okay, and then now they said on sales. So your sales will be 100%. Are we following? And then now, what is 100? Divide by 100 minus 30, you get 70. So far so good. Please let me know. So far so good. So now, okay, which amount do we have so far from transaction 1 and transaction 2? So let me just pull out transaction 1 and transaction 2. So transaction 1 and transaction 2. Remember, inventory is recorded at cost price. So it means we only have our cost price for inventory. So what is the cost price per bucket? It's 9 rand 50 cents. So remember, inventory it's recorded at cost price. So it means our price is 9 rand 50 cents. Keep that in mind. 9 rand 50, right? Yes. So it means our cost of sales will be 9 rand 50 per bucket, right? Okay, why 100%? We say 100% because now you are making a gross profit of 30% on the sales that you're making, right? You're making 30% gross profit on the 100% sales you're making. So the on part should guide you. So the word after on, know that it's 100%. Are we fine? Yes. So now you have 9 rand 50, which is your cost of sales, right? Okay, and then now, how do you get your sales or the selling price? So remember that formula, you take the amount. Remember our formula, take the amount, multiply by what you want in percentage over what you have in percentage, right? So now, what is our amount? Our amount is 9 rand 50 cent. So 9 rand 50 cent, we want our sales or the selling price. Multiply by what you want in terms of percentage. I want 100%, right? Divide by what I have. So 950, it's equivalent to 70%, right? And then you get 13.57. Okay, Mpo, if you just join in, okay, let me just answer you first. That 950, we got it from transaction number 2. So let me just show you first. Transaction number 2 at Mpo, we got our inventory. Remember, inventory is recorded at cost price. So the cost per bucket, it was 950. Right? So that's how we got our cost of sales, because inventory is recorded at cost price. So your cost of inventory is 950, right? So now you take this 950, you multiply by 100, you divide by 70 to get 13 rand 57, which is your selling price per unit. Okay, let me write it down. Per bucket. Right? At Jenny, please let me know where should I repeat. Let me know specifically which amount you didn't get, so that I can repeat that specific part only. Okay, so far so good, guys. Nah? So now, remember, I told you that these two twins, I like to call them twins because the amounts are the same. These two twins, they'll be at a cost price. But now these 3 transactions will be at the selling price. So now you have your cost price, you have the selling price, right? Okay, let's start with our cost of sales. So our cost of sales, it's 9 rand 50, right? So 9 rand 50, it's per bucket. But now we sold 10 buckets. So you're going to multiply by 10, right? And then you get 95. Okay, some of you are getting it. Spuda, I see you, sir. So you get 95. How do you get 95? You take 9 rand 50, which is the cost price, multiply by the 10 that we sold, right? Okay, sure. So now, remember this 9 rand 50, we took it from the inventory. And then inventory, it's exclusive of VAT, right? So it means whatever the amount you're going to get, when you multiply this by 100, divide by 70, it's going to be exclusive of VAT. So it means also this amount, it's exclusive of VAT, right? And then you ask yourself from this 1, 2, 3 line, which account here is exclusive of VAT? Sales is exclusive of VAT, right? So now it means to get my sales, can I do the calculation on this side? So to get my sales, I'll take 13 rand, which is the selling price, multiply by 10. Right? So now what is 13 rand 57 multiply by 10? You get 135.71. And then you ask yourself, sales is an income. Where does my income increases? On the credit side. So you're going to put it on the credit side, 135.70. Are we fine? So far so good, right? Okay, and then now, since I have my exclusive price, I can find my inclusive and my VAT. I just take 135.70 multiply by 115 if I want my trade receivable, because 115 is inclusive and trade receivable it's inclusive, right? So multiply by 115, divide by 100, you get, where am I? 1, you get, how much do you get? So it's 135.7 multiply by 115 over 100, and then you get 156.06, right? Are we getting the same answers? And then we want our output VAT, right? So to get our output VAT, to get 135.70 multiplied by 15 divided by 115. And then you get, are we getting the same amounts? Okay, guys, remember sales is exclusive of VAT, right? So 135.70 multiplied by what we want, which is 115, divided by 100, right? And then you get 156.06. At Jenny, do you see it? And then secondly, you're gonna calculate output VAT. You take 135.70 multiplied by 15 over 100, and then you get 20.36. And then remember, output VAT is a liability, and liability is on the credit side. And then when you add these two, you must get your trade receivable. Are we fine? Okay, before I move on, can we just confirm that we are fine with number 3? So far, so good. Please let me know that so far, so good. Let me know so far, so good. Are we fine, good people? Are we fine? Are we fine? Are we fine? Are we moving? Sure. Oh, we have Sipo in the house. We're not getting the same answers. Neo, what's happening? What's happening? Where are you stuck, say? Where are you stuck, say, or ma'am? Oh, a lady. Neo, please let us know where you're stuck. Let us know where you're stuck. It's a bit tricky, but we are fine. Yes. I know. Okay, guys, remember, when you ask a question, just say that, okay, how did you get that 1, 3? Like, be specific so that we can answer you. Be specific. Okay, can I move on, guys? Don't worry. Post your question there. A response will come. We have many hands in this. So, take a screenshot before I remove this. Take a screenshot. Because now, remember, you're going to refer to this. So some of you are not writing, you don't have a calculator, yeah. Then you say you're going to be an accountant. My goodness. Okay, number 4. Okay, guys, before I carry on, I see most of you're having questions. Okay, let me start with Enoch. Enoch, cost of sales of 95. How did you get it? Okay, Dr. Enoch. So on transaction number 2, Enoch, our inventory per bucket, it was 950, right? So now you take this 950, you multiply by 10 buckets that we sold. So 950 times 10, you will get the 95, right? Okay, let me answer Google. Google, how did you get the 20.36? Okay, the 20.36, which is the VAT, Google. I took the 135. Okay, let me start from scratch, Google. So I took 13. Remember the sales, the selling price per unit, which is 13.57, and then you multiply by 10, you get 135.70. That 135.70 is your sales, right? And then you take your sales amount, which is 135.70, you multiply by 15 because you want the VAT, divide by 100. Why divide by 100? Because the sales is exclusive of VAT. Are we fine? Oh, okay, my partner is here. Oh, Sipo is here. Sipo is here. He will answer your questions. So those who are copying, those who are fine, can we go to number 4? Can I get 5 thumbs that I can go to number 4? I don't want to leave anyone behind. Can we go to number 4? Number four. We are moving. Okay, so number 4 says, Binkosi settled their account with 007 traders. So 007 traders, it's us, right? So a customer settled an account, right? Okay, and then they received a discount of 2%, and then they told you that see transaction on February the 10th, right? Okay, so now let me, I had many questions about trade discount and discount allowed and discount received. So remember, settlement discount is divided into 2, right? Okay, let me take you back to the class. Settlement discount is divided into 2. You can have discount allowed and then there's discount received, right? So we have discount allowed, we have discount received. So with discount allowed, it's us, the business, allowing the discount to the customer, right? So it means for us, it's going to be an expense because we are losing, right? But now if it's us paying the supplier and then we receive a discount, it means now it's an income to us. And then you know that your income and expenses go to which statement? Statement of profit or loss, right? So now it's the customer paying, right? So it means we have to allow them a discount, right? Okay, so which accounts are affected? We are receiving money. When you receive money, your bank is affected. And then which statement is bank? Statement of financial position, right? And then now, okay, I'm seeing latecomers and now you're saying otherwise. Ish. Dr. Andile, I hope Sipo will help you because I say you missed the first part of our session. That's why you'll be lost there. Okay, so bank, statement of financial position, right? And then now remember, discount allowed, it's an expense. Where does expenses increase on the debit side? So it means you're going to have discount allowed here. And then it's an expense. So it will go to statement of profit or loss. Right? Are we fine? Okay. And then you have what? You have output VAT. And then output VAT is a liability. It goes to statement of financial position, right? And then you have lastly trade receivable, because now a customer is paying us, so the trade receivable should be affected. And then which statement? Statement of financial position. Are we fine, guys? Are we fine? So okay, now the amounts. So we have to refer to the previous transaction to see how much does Binkosi owe us. So that transaction number, oh, it's here. So that's transaction number 3. So transaction number 3, our trade receivable, it was how much? 156.06, right? So Binkosi owed us 156. So okay, keep that in mind. So now we need to decrease our trade receivable with, what is the amount? 156.06. remember, on the side, on the credit side, so credit debit, right? Because trade receivable is an asset, and then your asset decreases on the credit side, right? And then we give this person a 2% discount, right? So now if we give this person a 2% discount, it means on the bank side, we're just going to receive 98% of the amount that this person is owing us. So this person is owing us 156.06, right? So what is 98% of 156.06? So 156.06 times 98% divided by 100, you get 152.94, right? So it means we only received 152.94. Why we didn't receive 156, the amount that this person owed us in total? It's because we had a discount, right? So a discount decreased the amount that we're going to receive. Let me repeat that. A discount decreased the amount that we're going to receive. Thank you, Z. Thank you, Z. You are moving with me. Right? So now the 2%. So look at this, guys. So you have 156.06, right? Which is inclusive of VAT. You multiply by the 2%, right? So now we are looking for the discount. 156.06 multiplied by 2%. And then you get your discount as 3 Rand 12 cents. Right? So your discount is 3 Rand 12 cents. So remember I told you, if the amount is inclusive of VAT, the answer will be inclusive of VAT. But now, discount allowed, it's an expense. And then your expenses, they don't have what? They don't have VAT. They should be exclusive of VAT, right? So basically now, to get the discount allowed, you're going to say multiply by 100 over 115. And then your answer here is how much? So you have 3.12 multiplied by 100 exclusive divided by 115. Then you get 2 Rand 71. Right? So now this 2 Rand 71 will be your discount allowed. Discount allowed is an expense, and then expenses increases on the debit side. And then now you want what? The output amount. So to get the output, you have 3 Rand 12 multiplied by 15, because it's the percentage that you want, divided by 115. How much do you get? So 3.12 multiplied by 15 divided by 115. How much do you get, guys? Can you see Tulani? You are correct. Z, you are correct. How much do you get for the output? Okay, let me answer you. 0.4. Are we fine? Are we fine, guys? Are we fine? Are we fine? Are we fine? So 0.41, right? And then now we record this on the debit side, because now we are receiving the money. It's not our money, so we need to reverse the output VAT, because now when we sold, we said we credited output VAT, right? Are we fine? Are we fine? Are we fine? Okay, so can I move to transaction number 5? At Prudence, Sipo will answer you. No? Sipo will answer you. Can I move to the last transaction? Okay, what is the narration here? So remember they said we should state the narration. So the narration is that a customer, or you can say Binkosi, settled the account and generated a discount. Are we following? So that's the narration. A customer settled the account and granted a discount of 2%. Are we fine, guys? Are we fine? Okay. Can I move to the last one? Can I move to the last one so that we can do the accounting equation and the general ledger, and then so that we can leave 30 minutes for questions and answer. Next question. Yes, sir. So okay, lastly on the 28th, after stock count at the end of the month, it was discovered that 3 buckets were stolen, right? So 3 buckets were stolen. So now when your stock or when your inventory is stolen, what's going to happen to your inventory? Your inventory is going to decrease, right? And then you ask yourself, where does your inventory decrease? On the credit side. So it means we're going to credit our inventory. And which statement? Statement of financial position, because it's an asset. And then what is the contra account when inventory, it was stolen or damaged? We call it inventory adjustment. So inventory adjustment is an expense. So your expenses are debited. And then your expenses go to a statement of profit or loss. Right? And then we do the calculations now. Okay, this one is straightforward. 3 buckets were stolen. And then what is the price per bucket? Remember, guys, what is the price? Transaction number 3. What is the price? 9 rand what? 9 rand 50. Right? Because remember, inventory is recorded at cost price. So 9 rand 50 was your cost per bucket, right? And then you're going to say 3 multiplied by 9 rand 50. You get how much? 3 times 9 rand 50. You get 28 rand 50. Yes, Zanel, I'm with you. I'm with you. 28 rand 50. Are you guys following? Are you guys following? Are you fine with this transaction? What is the narration here? Inventory was stolen. Straightforward. So just give us a brief description of what's happening. Inventory was stolen. Are you guys fine? Are you guys fine? Can I get some thumbs up before I move to 3.2? So guys, remember, if you just logged in now, you are behind, right? So you weren't able to catch everything at once. So the video will be saved. So I think if you just logged in now, it's better if you don't ask questions, because now you're gonna take us back, and then yeah, you came late. So don't worry, the video will be posted here on Facebook and on YouTube before midnight. So okay, I'm moving, right? 3.2. Thank you guys. 3.2 says, prepare the inventory account in the general ledger of 007 for the month ended February 2019. Note, there was no inventory on hand on 31st January 2019. So that's the end of the first month. Now we are on the second month, which is February, right? So whatever is the closing balance on the previous month will be the opening balance on the next month, right? Whatever is the closing balance on the previous month will be the opening balance on the next month, right? So now we have inventory. So we know that inventory is an asset, and then your asset increases on the debit, they decrease on the credit, right? Okay, so now on 31st, so on 31st January, we had a balance of 0. Right? Okay, and then now I'm going to take you back to the transaction, because now we need to record everything that affected our inventory. So look at your journal. Transaction number 1, we debited inventory with 760, right? So it means now what's going to happen on the debit side? We need to increase our inventory with 760, because we bought inventory. On what? On credit. So trade payable is affected. Right? And then what happened on the second? On the second, we returned 1 bucket, right? So the fact that we return, our inventory is supposed to decrease, right? On which side? On the credit side, right? And then now, since we are returning, the trade payable account should also decrease, because now we don't owe them anymore 760, but 760 less the bucket that we returned, because it was damaged, right? How much was the price per bucket? It was 9 rand 50. Are we fine, guys? And then transaction number 3, did transaction number 3 affect your inventory? Yes, transaction number 3 affected our inventory. Why? Because now we sold, right? And then when we sell, we need to recognize our inventory at cost price, right? So it means here we're going to have cost of sales. So it cost us 95 Rand. That's transaction number 3 on the 10th, right? Why is the balance 0? On your question, they told you that there is no inventory on hand on 31st January 2019. So the balance will be 0 because whatever it's the closing balance of the previous month is the opening balance of the next month. So we are on February now. On January, we didn't have no inventory. The closing balance was 0. So that's why we have an opening balance of 0 on the following month, which is February, right? So, okay, where are we? On the 20, did our inventory be affected? No, it was a matter of a customer settling their account, right? And then on the 28th, did inventory be affected? Yes, our inventory was affected here. It was decreased with inventory adjustment because of the goods that were stolen, right? So now you're going to have inventory adjustment on the credit side with 28 Rand 50. So remember the 28 Rand 50, I took 99 Rand 50 multiplied by 3 because 3 goods were stolen, right? And then how do you balance this account? You look at which side it's more. So obviously the debit side is more. So you write the more side on the total. So 760, right? And then on the credit side, you say 760 less what you have on the credit. You have 950, you have 95, you have 28.50, and then you get 627, right? So this 627 will be your balance carried down, right? And then this balance carried down will be the one taken forward on 1st March. So remember, this one is the closing balance for February. So the closing balance is the opening balance of the next month, right? So it will be your balance brought down for March. Are we fine? So it means now this one, it was the closing balance for January. Now it's the opening balance for February, which is 0, because they told us that we don't have inventory on hand, right? So are we fine with the T account for inventory? So remember, I told you that general ledger, journals, and what? Accounting equation. So I'm going to do 2 transactions on accounting equation, and then we are done. So it's a matter of recording. We don't have to do calculations because already we have the amounts, right? So remember, accounting equation, asset equals to equity plus liability, right? So I'm going to do transaction number 1 and transaction number 3. Inventory adjustment is an expense. Yes, Andy, it's an expense. So transaction number 1, remember. Okay, let me just pull through what we did. So transaction number 1, we purchased inventory. So we debited inventory with 760. We debited input VAT with 114. We created trade payable with 874, right? So now let's put this general journal on the accounting equation, right? Okay, so remember, it's an asset, it's a liability, right? And then what you have on the debit side should be equivalent to what you have on the credit side, right? Okay, so now let's start. Inventory. So inventory, it was an asset, right? And then we debited our inventory. So debit inventory, right? So the fact that you are debiting, it means the amount will be a plus. Why is it a plus? Because our assets are increasing on the debit side. What was the amount? 7 Rand 60, right? Which another set account did we have? We had input VAT. So will the amount be a positive or a negative? Will be a positive, right? And then what was the amount? 4. Okay, and then another account we had trade payable. And then trade payable is a liability. So we have nothing under equity, but we have something under liability. What was that? It was trade payable. And then trade payable, it was credited. So your liability increases on the credit side. Trade payable. Amount. It's a plus because liabilities increases on the credit side. 874. So now with accounting equation, it's supposed to balance. What you have on the left-hand side should be equivalent to what you have on the right-hand side. So you have 760 plus 114. You must get 874, right? So that's transaction number 1. And then I'm going to do transaction number 3, the one that we sold on the 10. So, okay, let me show you the amounts, but I believe you're supposed to have the amounts on transaction number 3. So transaction number 3 we sold on credit. Okay, I know it's a lot. Let's start with this 3-line journal first. The one that's affecting the selling price, right? So we debited trade receivable because we're selling on credit with 156.06. And then we created sales because it's an income with 135.70. And then we created our output VAT because it's a liability with 20.36. So let's start with that on the accounting equation, right? Okay. So first thing, trade receivable is an asset. And then when we sell on credit, our trade receivable is increasing. And then where does your asset increase? On the debit side. So you're going to debit your trade receivable. Since it's a debit and my asset increase on the debit, it's a plus. What is the amount? 156.06. Right? Do I have any asset here on my 3-line journal? So far, no. I have my sales. Okay, sales is an income. But now on my accounting equation, I don't have income here. I only have equity. Okay, Franz, how do we do this? Do you remember this, guys? Dies. Equity is dies. So D is for drawings, I is for income, C is for expenses. Right? So now your drawings and your expenses decreases your equity account on the debit side. Okay, let me write that. let me write that. So equity is the same when we say dies. Counting is nice. Now we are gambling here. So dies. So D is for drawings. I is for income. C is for capital. E is for expenses. Right? So now I'm saying to you that my drawings and my expenses decrease equity on the debit side. Right? And then now my capital and income increase equity on the credit side. Right? Why is that? Remember, drawings and expenses increases on the debit side. But now since they increase on the debit side, they will decrease equity because equity decreases on the debit side. Are we fine? What's happening? The camera is blurry. So let me use a black marker. Right? So yes. So I have my sales. And my sales is my income. And my income increases my equity on the credit side. So it means now you're going to do what? You're going to... What's happening? My camera is tired, guys. So you're going to credit sales with a positive because my equity increases on the credit side. It's a plus. What was the amount? 135.70. Right? Yes, guys, you must buy those gadgets, those camera holding things. Yeah. Okay. So credit sales plus 135.70. But you can listen to me. Listen to what I'm saying. Credit sales plus 135.70. And then lastly, we have what? Output VAT. So output VAT, it's a liability, right? And then your liability increases on the credit side. So it means you're going to credit output with a plus of 20.36. Are we fine, guys? And then lastly, we're going to do the last part, which is cost of sales and inventory. Our cost of sales and inventory is 95 Rand. How did we get the 95? We took 9.50 Rand multiplied by 10 units that we sold, right? Okay, so keep that in mind, 95 Rand. So now we have cost of sales and inventory. Which one is an asset there? Inventory is an asset, right? Okay, what happened to my inventory? The fact that I'm selling, inventory is decreasing. And where does your asset decrease? On the credit side. So inventory, and then it's a minus because I'm selling 95, right? And then cost of sales is an expense. And then where does your expenses increase? My expenses increases on the debit side, but my expenses decrease the equity account. Where does your equity account decrease? On the debit side, right? So it means now if I'm debiting my cost of sales, and then equity decreases on the debit side, it means the amount should be a minus. So a minus 95, right? 5 on the left hand side and negative 95 on the left hand side. Primary, they say what you do on the left hand side, you also do on the right hand side. So guys, are we fine? 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 Okay, let me just show you so that you can take the screenshot. So okay, on my camera it's clear, it's clear. I don't know what's happening. So please take a screenshot.